Morning traders, welcome to the Traders Lab. I'm your host, Tom B. Can I please get a screen and audio check in YouTube and the Bookmap Discord Trader Lab? Morning, Marty. How we doing in YouTube this morning? Hope everybody's doing okay. Thanks. Well, good morning, everybody. Welcome to the Traders Lab. I'm your host, Tom B. Thanks for visiting today. I stream live Monday through Friday, 11:30 to 1 p. Eastern Standard Time. And this stream's about integrating Bookmap Orderflow tools with auction market theory using the volume profiles of chassis in the intraday developing time frame. It's based on structured trades that you can reverse engineer and build into a vetted trade plan. Idea Trader Lab, it's a group of like-minded traders who've come together to leverage their collective experience. It doesn't matter how long you've been trading, what you do, how you do it. The thing is, the business of trading is a statistically based business, not a certainty or confirmation business. And psychologically, most of us look for certainty. And that's because of our primal wiring or risk aversion. So we're always subject to these emotional pulls or chemicals that are released in our brain. And this is maybe the primary reason that most retail traders have such a high failure rate is they cannot manage their emotional states. Well, and most of us are kind of making it up as we go, or many of us, I should say, who have in the past, or we think it's a video game and we're just chasing rotations. Reality of the business is really different, in my opinion. And if you are working hard, but waking up in the same place in spite of having winning trades, and don't forget, gamblers have winning hands, that ought to give you a little message about the business you're in. Then maybe you want to sit on the house side of the table, only interacting when you have a statistical edge, even though you will pay the gamblers. So how do casinos pay the gamblers, give you the cocktails and the ticket to the buffet, and still net a profit after all their overhead? It's because they only play games with an edge, but they only control how they play the game. They don't control the cards coming out of the deck or how gamblers play the game. So the control lays with them. So in the trading business, it's the same exact business model. That is controlling the things you control, which is your behavior, hopefully, and a statistical edge. And then the rest is up to a random distribution of outcomes. That's the business. So that is the business of trading. So how can we take the business of trading and overlay it on the business of gaming? That's the purpose of Trader Lab, and that's to help you understand the business you're trying to be in and potentially create a career path and process that you can replicate and make your own. Welcome again to the Trader Lab, and thanks for visiting. We've got a lot to talk about, of course, today. So let's take care of business and let's move along. General disclosure, all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember, this is not a trade calling room. If we get to it, as they say, we'll talk. Whoa. By the way, I'm on a laptop. I'm in Mexico, so sometimes things can go bump in the night. Okay. Don't forget about Bruce's pilot program. This is about developing a edge in trading and using Bookmap tools, replays, statistical extraction tool, journaling, and the rest of it. These are built-in tools. In Bookmap, you can learn better how to use those and move yourself along in developing that statistical edge. Also, there's 60 PDFs I created of actual trades, and others are screenshots. And these are many years ago when traders were asking me, what are you doing? They're just examples. And by the way, I don't want to disappoint anyone, but there is no plug and play in trading. If it was that way, we all would have done it. And of course, then you'd have 2 ATMs in the basement instead of none. So plug and play doesn't work in trading. And when I go out on the internet into YouTube world and I get the only thing you need and this one thing and all that, you've all seen it and you've probably all done it. I'm going to say You only have two things in this business: assets or dollars, and time. Don't waste your assets. Don't waste your time. This is a trading process hierarchy I created, and it just gives you an idea of a sequence of process. Trading is process oriented. The same as playing blackjack. It's process. And that means they shuffle the cards so many times, they cut the deck so many times, they deal the number of cards, they do the rest of it, right? That's a process. The fixed or anchored inputs of a process are what help you extract an edge. The games are always played the same way. In our business, the trades are always traded the same way. The outcome, just like in the casinos, is random. Once the trade leaves your hands, it's up to the other participants in the random rotations and distribution of outcomes. That's the same here. The thing is, how do we extract this edge? How do we define market conditions? Well, auction market theory is the primary element. And what is this auction thing? It's shopping. Let's make it what it is. What is too high, what's too low, and what's fair? And in all rotations or time frames, the market is trying to figure this out. So the participants auction. And if you go to the store, you're participating in an auction, but it's in a very high time frame, if you will. Prices don't change that much. High volume is created at a retail price, so that's the auction. But if a price gets too high, you'll have price resistance. There'll be less buyers. So you might pay it, but the volume will drop off if the price is too high, or you'll get an alternative product. And the price goes on sale, you throw 3 in the cart. It's the same thing here. But in our business, the rotation, since we're day traders, can get into minutia. But that process takes place in all time frames as you think of them. The volume profile lets us see the volume distribution. The time frame is what you determine you're going to trade. And that can be intermediate time frame, daily time frame, monthly time frames, or micro time frames. Doesn't matter. The behavior's generic. The time frame is what you operate in and can create a risk reward that gives an edge to you. Context, this is a biggie, and this is hard for developing traders. That is the condition of the market. Again, subject to time frame. You may think in a higher time frame we're in a bull market. Other traders in an intermediate time frame may think that we're going lower, though the higher time frame is still bullish, subject to how you interpreted time. And as a day trader, we may be trading long and short intraday. So that's where the definition of time frame. So in your time frame, is the trend up or down? You see? So you can be in an uptrend and you can be short all day. So is that a conflict? No, it's a definition of time or auction. So these are the elements that as developing traders, we need to put together and define with something called anchored inputs. And then Bookmap's the order flow tool. It's kind of like, I call it the tip of the spear. This is where we get into the minutia to read the order flow to see the behavior of the participants in as short a time frame as we need to in order to define change in behavior. And then it extrapolates from the microstructure on up into higher structure. So think of a vertical integration of time frames. I kind of think of them as Matryoshka dolls or Russian dolls. That's another way to think of time frame. Hope that makes sense, guys. So now let's go to our context grid sheets. The context grid sheet is available to you in the Trader Lab. In fact, I did a primer webinar that talks about this process. It's got about 34,000 views. It's in the library in the Trader Lab, plus a full library of webinars, some up to 4.5 hours long of real-time narration. So you can see this unfold, and change in many different configurations. I mean, a lot of traders ask me, can you narrate in real time? Well, I don't have that time here in the stream. But if you're interested, there's many of these that are in the library, plus there's a document section. And in that document section is the context sheet. So let's read the context sheet. Trader Lab participants, make sure you have this out in front of you. Part of this has to do with developing unconscious competence. Repetition, no different than driving a car or riding a bike, makes this, instead of an abstract concept, makes it visceral. In other words, you experience it, you recognize it. Remember when you rode a bike and you guys start on a 3-wheeler, Then you went up and up and up, to a small two-wheeler bike, and then a larger one, and then you were like a Hell's Angels. We used to put baseball cards in the spokes so we could think we were a motorcycle. And then upgraded to balloons. You guys ever put balloons on your bike? So believe me, it didn't go well with the neighbors. Okay, context sheet. We opened out of range today in a gap. So let's get to Bookmap. Whoops. Oh, sorry. Before we do that, I want to go over, this is a higher time frame, and this is Thursday. Now, this is what we had going on Thursday. So as of Thursday, we came down. Now, we tested Wednesday's value area low, and this is important. What this is saying is this is the fair price or area of where most of the business was done. This was the retail price or high volume. Remember, shopping, and we rejected it. We came back up. We tested the value area low, and we tested something called the micro composite intermediate time frame high volume or retail price, 69.08. Now, this is all important. Then, and if you guys remember, very tricky on, I think it was Thursday, where we opened down here, went down first, came across the range, came up here, and then went down and made a lower low. So that was kind of a tricky day. And of course, every day can be tricky, but that's neither here nor there. The retail price was, can't quite see it, but I think it was 69.06-ish from Thursday. I hope I got that right. And then we came down, but we did not fill this gap. So we have a gap here. We have another gap under here. And the retail price from this day, and again, I can't read it very well. I think it was 69.30, 68.30. I'm sorry. So this was, now let's go to the next day till Friday. Now, on Friday, we test the retail price up around 69.01.02. Now, here's another thing. The intermediate retail price was at 69.08. This is all very material, 69.08. Okay. Now, and the retail price from Thursday, roughly 6,900-ish. Let's go back. So now 6,900-ish, right? Too high. And then we go down, we take this low out, and we finish filling the gap. So what do we have below us again? 68.30, the retail price from here. We have gaps open below over here. And this here was the breakout of the consolidation where we gapped and then gap, and now we're coming back. And the market, as you guys know, tends to come back to these areas. This is the lay of the land. So we have 68.30. We have 69.08. Okay, so we have these levels. Now we're ready to go to our context sheet. And guys, why would we do any of this? Why would we care about this? Because this is the auction. This is how the market works. So let's see what happens now. Let's go to the levels. Yesterday's high, 69.08, right? That was the retail price. That is now too high. Yesterday's high, what's over Friday's high? Stops. And what comes in over here? Resting liquidity. Now, this is before the RTH open. So what we know is, now, this is all before. The new, so we have stops here. And what does the market tend to do? The market tends to go up to go down and goes down to go up. What did it do on Friday? It went down. Okay, fill the gap. So Friday's high. What's over Friday's high? Stops. Thanks for playing. You get a coupon to the buffet. ETH high, and we open at the ETH high. Now, here we have resting liquidity, and this is our 69.08. So there's alignment, and there's stops. So I did not trade this one well. I'm going to tell you that. got a little bit, I missed putting a level on my chart. No excuses. But I want to show you the trade. I can see the trade, but I saw the trade and I was thinking at the time, and I didn't have this level, which is my error. I made an error. I didn't have a level on the chart, and I was looking for it to take the stops out here and go down. So I had a different level on my chart, and that level, so I made an error. And I got to tell you that. I tell you, I make errors. I take stops. So I did. But this is a short, so I didn't take it. So let's look at it. So here's what I'm not going to spend much time on what I was doing, but I was looking for it to come across here and squeeze and get up to the next level, this. So that was my plan, to come up and come down. So instead, it opened into the liquidity, into the level. Say, this is where you want to take the, the baseball bat out or step on the rake a few times. So anyway, this is called variable high volume node. This is the initial RTH open where we have buyers and we have this. So I have alignment and the ETH high. ETH high has a high probability. Now, we opened out of range in the gap. What does it mean? I'm back to my context sheet. Sorry, I'm a little distracted here this morning. Market is out of balance. Now, the first question becomes, is the market responsive? Now, what does responsive mean? Sellers are responding to the gap. It's like, oh, really? Come on, take some. So what it is do we get our sellers or do we squeeze and get sellers? So my thing was, that's my error, was I was looking for the buyers to squeeze to respond. So I was looking for up, down, said I got down. So we'll go on from there. So this is a short. Now, in 14, not even a second here, I think it's 14 seconds, I cannot respond to this. And if I was on my toes, this tells me to get short. This tells me, this is called VPOC migration. This is a potential short. Mid would be a short. VWAP, by the way, which is showing here, is not accurate. On rollover, things can get a little funky. And if you have Bookmap, you need to change your reset time configuration for anything that's time sensitive. So the full session VWAP is correct, which was here, but the regular VWAP is out of whack. So for VWAP, I have to use my export level, which is currently not here because it's current. So this is the first short. Stop would have to be above this liquidity. If that fits, you're fine. If not, then your stop would be up here. So this is called VPOC migration. Now, if we get responsive selling, what does it mean? We fade the gap back into balance. What is balance? Balance would be here. And so that's called value area high. We also have that micro composite volume point of control, 6894, and the overnight volume point of control. Now, so it's a fade, and if we're opening higher outside of range, there's a probability, in past performance, not indicative of future results, you got to vet everything for yourself, no matter what you hear, where you hear it. There's an 81% probability we get here. So if I get short here, the scale, subject to your plan, would be here because there's an 81% probability. So starting out, you're going for this or wherever, subject to your plan. Now, I'm going to label this. It's a variable high volume node. I made a term up. That's what I call it. Why? It moved. So I guess it's variable. And what does it represent? High volume. Let's go back to your supermarket. High volume is a retail price. But what happens if now we don't want to pay it? We get in a car, we leave it, and we go and we're going to try to look for another price. In the ETH, the high volume was here. Well, if in the RTH, this is the new retail price and we reject it, we're going to go back to the previous store. I just think of it as shopping. And what it's doing, remember, this is a pricing mechanism. So that's why 82% probability. And who knows, right? And by the way, Statistics are all they are is a what? Statistic. Now, what do we know about this? If I break below this, it might mean it's too high. So I'm going to label this. Also, I have resting liquidity. Two possibilities here. Let me show you this. This is liquidity trigger. A little advanced, but you can learn this. And I'm not done with my context. Value area high. I got to give you that statistic. You might think this is a lot of work, guys. There's about a 55% probability that I get there. Okay, but an 82% probability to get there. And I have this. Now I'm going to label this. Let's just watch a process. This is a process. I'm not saying it's the process. I'm saying it's a way to organize material information. Come down. So I can do this. I can go from here and come back because it's too low. Remember the shopping. And what's at the high? It was too high. The VPOC, the VHVN. I'm not paying that. Here, is this too low? I can do this. And I got the liquidity. That means the buyers. Or if I break below it and now that's too high, I can continue lower. One moment. I got to turn off some levels here that we're getting that are current, and we don't want those at the moment. One moment. Okay. Okay. So this here is a target, and it's the fair price, retail price from overnight, and either that or that, and the liquidity. If I break below it, I have the following. This is a liquidity trigger. And this is a bit advanced. This is overflow or order flow oriented. So let's go back to our grid sheet. Is the market responsive? Yes. What do we do? Fade the gap into balance. Where are we now? We're going into balance. We have to watch for a bounce and a retest of the previous range. We're in the previous range and the previous value area. Previous value area is here. So either we're going to get a that or a that. So this is a critical area, and we get this. You can sell this. And what happens then is the prior range holding. Well, we're not coming out of it. So what does it say? It is not. The fade is still valid, and we had to watch for the reaction or test of the previous value area. We're inside it. What does it mean? Is the prior value area holding? Well, no, it's not. The market has rejected it. Here's what it says. High probability of trading through the previous value area, and the market's rejected new interpretation. What does it mean? Potential to turn into an outside day. Why? This is all in a grid sheet. It's kind of a logic grid sheet I put together many years ago for myself. The market has broken out of balance and rejected the imbalance. That means the gap higher. This suggests position traders feel new sentiments are unwarranted, so we revert to the mean, which says south by southwest. Overnight mid, what's the probability of getting the overnight mid, you ask? 68% probability to get there. You have to vet this. So this is a short. Now we have another scenario here. Let's look at this. What is this? Another order flow trigger. This is more advanced. Break here, so you could sell this. Key level inside. What is this? 68% probability. Order flow. Get a sweep here. This says potential for counter rotation. This would be your resistance. Break here. Break here. These are short. Stop would be here. Ads. And this is Trader Lab. Now, this is resistance going down the financial food chain. VPOC migration. Now, this is an important event. What this sets up here is this is the new retail price in the developing time frame. Watch. Now, this thing is really pretty directional, wouldn't you say? And it's, for me, it's like, oh, that's interesting. Well, now I know I'm rejecting everything above. Now, you do remember 68.75. here. This is the retail price from Friday. So we came up this morning, rejected this retail price from Wednesday. I got this right, or tested this. This is Friday. Came up here, 69.08, key level. This is now I'm going into today. One moment. So this is today. So tested this key level. This is what the auction is about. You can learn this. So that level right there is the high of the day. It was also too high. Took the stops out here. Remember, the market goes up to go down, goes down to go up, goes up to go down. Why? We're squeezing these guys out. There's your resistance. Now 68.75 is the retail price from here. It's a target, and value area low, target, and then the potential to go here and take yesterday's low out or not. Doesn't matter. You know, we're not in that part of the business, but you can see the structure. So the thing with the auction is it's not predictive. What it can do for us is it offers us an opportunity to understand how the market works. These are not indicators. This is really what the market is all about. It's not your indicators. And most of us grow up in the business with indicators because we think plug and play is the answer. So, let's get more indicators and more time frames. It doesn't work that way. Where's resistance? And why is it resistance? This is an order flow trigger right here. Right here, break low, test, sweep. This is a short continuation trade, up to you. And there's that target at 75. You could be shorting coming down if you vetted these, short here, going for this statistic. The point of control, as it's called, has about a 38% probability. Now you're going to notice as we're going down, the probabilities are going down. But what these statistics don't understand or not part of the statistic is something called context. Remember context. And the context is we'll see you later. So even though statistics are now going in the other direction, the condition of the market is what suggests how we traded. So too high. Now we break here. We have another one of these. Now, this is resistance. So let's just follow how it works. And then we have, the overnight low settlement, but there's more. So all it is shorts. Notice where we come back. We check here. We break below it. Now, if you're mechanical and you sell this, you might take a stop. This is very much where the trade would fail. So here, when it breaks low, you can sell it against here. And your stop still has to be up there. So if you're taking this trade, if this is outside your risk parameter, you don't have a trade. You're also under here. A lot of volatility in this. I'm not saying these are trades you should take. I'm just saying trades you could learn. And what was that value area low? Remember, that is a target. Now, again, that's a low probability. It's only 20%. But remember what it said. In this context, we have to go back. High probability of trading through the value area. That's the end of the value area. High probability. So the statistics are, the context sheet supersedes the statistics, just so you know. So this is the next target. So what I tend to do is I trade the targets. And I tend to, and what's this, Tom? Come back here. What is this? Let me try this again. Hold on. Got to move this over. When I'm doing this with these order flow triggers, I see them as support and resistance. And I early on when I was learning this and working with Bookmap, if I can grab this, This was just something that kind of evolved for me over a number of years with this. And what is this? You see this here? This is where the buyers were, and they got run over. So what it is, if we come back to this level, and there was a sweep which suggested shorts, I can look at it again and see now if I get sellers up here. And this is a trigger right here. This is a triggering structure in alignment. Okay. And so this is a short. And this now, you get VPOC migration. The objective is to get short, get risk neutral here, because this is now the retail price. Remember what this represents. This is where the shoppers are willing to pay. And if you get a retail price that's too high, you're not going to pay it. But we have to remember these levels, because if we find too low, we can come back. So this is an order flow trigger. This is where the trade would fail. This is your scale, and then you're going lower. Now, we have more. Gotta try to find this here. Okay. At 9:30, we have something called the initial balance. The initial balance is the first. There's the IB high low has over a 98% probability that we take out either the first hour's high or low. All things considered, and anything is possible, of course, I'm looking statistically, I'm suspecting the first hour's low. Okay, because we do have a probability or a possibility for an outside day. So that's not off the table, but anything can happen. This is trading. So what I do is I mark this on my chart, and now I'm going to start looking for where my resistance is. So I have resistance here. So at 9:30, this is where the IB is, right here. I take it out. So we got that statistic filled. Now this now becomes the low of the day, becomes support. There's my liquidity. I got to mark this. Now, there's a couple other things that can happen here. This is the IB, which I'm going to mark. And we have another trade here, which for me is not qualified. And that's called, so there's two trade possibilities here. Right at the IB, we have, don't forget there's buyers here. Okay. Right here at the IB, there's two possibilities. There's something called the IB continuation trade, which is a short to continue down to yesterday's low, where there's stops. And if we keep going, maybe get here, another VPOC down around 30. So this is a possible target if we come out and take out yesterday's low. So that's one. The other trade, and this is not a trade I take, hold on one second. It's called the IB failure. I made it up. And what it is a reversion trade. However, in this context, it doesn't qualify for me. It does qualify as a trade management. And what the IBF is, and this has a huge range. I mean, the range on this thing is exceptional. So the possibility is, if you get this reversion trade, which would take you back here eventually, for me, it's an exit and not a reversal. Other traders in TraderLab trade this. But for developing traders, and I'm always thinking about developing traders. Now, we're all developing traders, but if you're building a business, what you need to understand is context. So you'd be short, 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 short. And here's the options on it. Developing trader, this is a trade management process. It means cover your short and hang out. Or you get the IBC, which means continuation short. So you have the IB continuation, or what's called IB failure. With this kind of extended range, anything goes, of course, because the trend is down, but you can get a counter rotation. Developing traders who haven't vetted the IBF, and IBF, which is this reversion, must be in alignment with the context. The context is down, it doesn't qualify. It qualifies for trade management. It does not qualify for mean reversion for a developing trader who isn't already profitable trading with the trend. I always say the probabilities, the wind at your back, favors just taking the short trades and developing an understanding of trade management. To become a counter trend trader, you need to understand what is counter trend and be able to use the counter trend triggers and locations for trade management, not take the trades. Now, developing traders, usually FOMO is what drives them, and they put themselves out of the business because they can't control their greed or FOMO. You're taking this trade without being a profitable trader, all you're doing is putting yourself out of the business. I don't want to sound harsh, but you do this for 46 years. You see a lot of traders who might have been able to sustain themselves, put themselves out of business. And we all think we're exceptional and we're not going to be the ones. Statistics prove otherwise. That's why there's over a 90% failure rate. And that's assuming you even have an opportunity to learn how to trade. Liquidity was here. Liquidity comes back in. IBF, this says mean reversion, possibility to come here or here. And then this is the mean. And then either rotate down to test this or keep going. Nobody knows. So again, this is not a long unless you have a statistical edge and you're already profitable trading in alignment, not fading. Watch. Now, we get VPOC migration. What is the language of the market? Too high. So, what do you do with this? Let's look. By the way, if you guys have questions, post them. I can't see the chats at the moment. I'm on a laptop. Let me tell you, that's a thrill. And I'm streaming from Mexico, so it does present some challenges to see everything at the same time. So this here, where we had this location and liquidity, is an opportunity, right? Let me extend this. I'm going to show this to you. And by the way, in case you didn't know, I take stops too. Everybody takes stops. The only people who don't take stops are the influencers and the peddlers. For some reason, they seem to be perfect. Not the way it works, right? You know that. I know that. So we got to get over not being fantasy island. Every business has overhead and cost of production. This is a potential short. Now, the thing with this is trying to get in alignment to come back to here. So this trade from here, this is a variable high volume node. What's the language of the market? This was Thursday's, I believe, retail price, 74. Yes. If it's too high, then I can come back and check it. I can come back and check this, the variable high volume node, compound elements, and I have the liquidity. I'm going to lose all of this. But I'm going to come back and check. So I got liquidity comes in here. Just try to get back to this thing. Here. So this sets up a short, I believe. Make sure I got the right thing. Yeah. This sets up a short here. The idea is to come here and go down there. Okay. So this one, and this is the full session VWAP. So this one, the idea here is to get short. Stop's got to be up here. Depending where you sell it, you'd either get risk neutral, and the goal is to come here, or you would take a stop. It's just a matter of location. So let's assume we take a stop on this one, okay? Now we're going to come outside and we're coming out. Now the thing we have to be aware of here, there's two aspects to this. One is reversion long, which it achieved, and the other one is to come outside to revert short and come down here. I'm sorry, guys, I got to the wrong location. Did I do this wrong? Let me make sure. Okay. So IBF was to come back here. All right. I think. Okay, it's there. spot. Yeah, this trade, we would, even if you took it here, or here you'd get risk neutral. Here you'd probably get risk neutral because we typically try to cover our risk on a runner, and then your objective would be come down here. That was the trade. Let's assume you took the trade, whether it would be here or here, and you would take a stop, or you'd be scaled and scratch. And let's just assume it's a stop. We don't candy code any of this. Now we get VPOC migration, and what this is saying, this now might be too low. So it's beginning to change. We just keep up with this. I still can't see the chats. I'm going to stop here in a moment after we see the behavior here. Notice what you get here. So what you get here is break, and this would be your scale ahead of this. And again, you're looking to come down here. Outside edge, sweep. These are shorts, but you can see they're having trouble. And the idea would be to, and this liquidity comes in. This is where you're trying to go, right ahead of here for your scale. So if you're taking this, you're trying to come here, and the trade would be to come here. Very choppy now. So now, once we're pushing through, I would have no more shorts. I would be done for the time being. So I have no more trades here. Let me take a look out here now. We have liquidity sitting here, and what we're doing is now we might have found too low because we're coming back over these places that were too high. So now it's really just rotational trading. So in here, if we're going to try, and these aren't trade recommendations, this would be almost scalping. I don't trade like this because my risk on any trade is pretty similar, whether I'm going for 20 points or I'm going here. And right now I'm getting the shorts covering because we had quite a downdraft here. So I have to be looking up into this area. We ran quickly here, so there's not a lot of volume. Let me get back here, take a look. This is a low volume area. So we can come out here and start rotating to come back here. This would be reversion. What's hard with reversion trading is trying to find the outside edge. Let me turn some levels on and get these chats back. And if you have questions, thanks for your patience. Let me try to get things working again. You'll see the levels show up here and here. It's going to show us where the outside edges are of the distributions and where the high volume nodes are. So let's wait and we'll see those. Now I'm going to find the chats. Okay. Okay, guys, how we doing in Trader Lab? How we doing in YouTube? Sorry about that. No, Ben, when I say scale, it's about getting risk neutral. This requires a minimum two-lot configuration. The idea of the first contract is to buy the stop on your runner, and then it's trade management or statistical target. If a trader's doing one in, one out, they're actually hurting themselves because when you can get risk neutral, and we all take full stops, you are going to get better control over your fear and your FOMO. And then you can just let the trade work because the market always rotates. I mean, you go from euphoria to depression. You know, if you're risk neutral, you can allow, if this is not your target, then you can just basically let it take you out. Or you have a trade management process that's vetted, so you make a few burgers. The goal in trading is risk. You need to protect your account at all times. Trading with a two lot And now, how do we know we want to put on a 2-lot? Well, because we need to know what our probability is of covering our stop on our runner before getting stopped out. So let's assume you do the work and you know under specific conditions you have a better than 50-50 chance of getting risk neutral. So let's say it's 60%. I'm just making a number up, but you need to know the number. When you have something tangible, that gives you control over your emotions, because your emotions are going to be telling you FOMO here, hold it to zero. Here, you want to bail out. And how many times do we bail out of the trade because we want to save a couple of ticks and never gets over these sellers, and then it takes out this counter rotation and goes to new lows? How many times does that happen? It happened to me a lot early on. So I found that if I could create a statistical edge, notice here we bumped the liquidity. Now, trying to pick outside edges, very difficult for mean reversion. So I don't. I just look at locations. The location is out here and here. Well, I'm not at either of them. So there's nothing for me to do here. So statistically, if I know I have a high probability, and some of this goes back to the average true range or the rotations given the volatility of the day, so there's a few more elements. What is my probability of getting risk neutral? Let's just say I have a 60% probability for even numbers. Instead of being fearful and looking for confirmation, which only, by the way, increases your risk, doesn't confirm anything, and all it does is increase your losses. If you have a 50-50 chance with confirmation or without confirmation, and that's all you have, or I have a 60% probability with a 50-50 outcome of that individual trade, what gives me the confidence to put the trade on without confirmation? The statistics. So I'm not waiting for confirmation, which means nothing except additional risk. I'm getting in with less risk because I know my location and I'm going to execute without confirmation. I'm going to use microstructure. Right here is microstructure. Micro, high volume here, liquidity here. This is a trigger. Now, it's not at a location. It's not qualified. This is the entry. The stop will go here. I'm just showing you an example. And the idea is to come down theoretically there. Is that a trade you ought to take? Now, I don't call trades. This is the location. Mean reversion is mean. Why? You could have taken the trade here and you take a stop. But if I'm following a plan, I have, let's just assume it's at a location and I vetted this, then I have an entry here with this, and it's not, this is not a qualified trade. And the idea of this trade, if it was vetted, would be a 60% probability. And I have to enter this thing. Let me show you the actual entry for it. Now, you would know this, and it's not my trade. I'm just telling you this is not a trade I would take because it's not at the location that qualifies it, but it has a lot of the pieces. This is order flow. This is like a backstop. I see my sellers here. I see delta, so I have aggressors. Those are the buy stops. You see them 254, 38. Now, up here, I'm higher. And I see, so I have a lot of buyers here, and now I'm seeing my sellers. Where'd my buyers go? Now I have more sellers. So right here, when I have a trigger, when I break below the buyers who are right there and the sellers are there, this is a auction, microstructure. I break low, I can sell it there, or I can sell it here, and the stop has to go there. Now remember, I'm not at a location, and this is not a trade recommendation. If this was elsewhere, it might be qualified up here. Now, this is an outside edge, but we're pushing outside. So any of these outside edges might be qualified. This is not a trade I would take. And even if it was, I'm not going to say it to you because I take stops. But we'll look at this and go, well, if I take this trade and I get my sellers, I want to see I don't want to see the buyers. I want to see the sellers absorbing the buyers. So I don't have my buyers yet. I still have my sellers. Now, if my sellers can't go lower, that means there's passive buyers here. So let's see what it does here. Stop would go there. And guys, this is not a trade recommendation, and it's not even a trade I would take. But you can see a lot of the elements here. So let's say if this was a qualified trade and I had a 60% probability if I entered here to get risk neutral. And if, let's say I have my entry is here, let's just say it's 87.5, and my stop would be, it could either be 3 ticks above here, right here. Again, not a trade I can take. It's not one of my trades, but it's structurally. So the stop would need to be here, and you're going to try to go lower. So this thing about a 60% scale probability, instead of being driven by your emotions, which would be FOMO by the time it's down here, or do you get in here with understanding your risk with an X% probability? And again, this isn't the trade that would do that. But if it did, if you had a 60% probability, you're not going to look for confirmation anymore. You're going to look at your statistics, and your statistics are going to suggest that the odds favor you getting risk neutral. Is that a trade you'd put on versus looking for confirmation? You see. Does that make sense? So there's no trade here, but this is an element of trade management and also not taking trades in the middle of nowhere. Trade location, there's a number of elements. This is an outside edge of a distribution in a developing time frame. It's really over here. Now, this is not located in the ideal spot. Advanced traders might determine to do something with this. But for the stream, this is really more a location. And the idea is a short would be to come back here. So this is your obstacle. This is a sweep. So this is why if you took a trade here, your stop's got to be out here. If you took this trade, this is not a qualified trade, but this is where you're trying to go. It's called mean reversion. And the point of being able to get a scale, if you took this, is to be able to leave your stop and not panic. Because emotionally, you go from euphoria to depression. By the way, this is another entry here, and your stop goes here. So this is a structure. This has many pieces of a trade that you'd learn in Trade Lab. Joe, my composite chart is ESZ. Yes, and the session time is 9:30 to 5 p. Eastern Standard. And this is Investor RT. This is accurate. This uses MBO data, Rhythmic, and this is an accurate product. So it depends on the product you use. So if you're using Investor RT, they should agree. If you're using a different platform, there's a reasonable chance it won't agree. It just depends on the accuracy. So what you're going to try to do with this is get here. So this is called mean reversion. Now, again, this might not be a trade I would take or anybody should take, but the behavior is, remember how the market works. It's what's too high, on the other side, what's too low, what's fair. Currently, this is the fair price or retail. So if the market stretches, and don't forget what's up here. So we have order flow, we have a sweep, we have a structure. Now we got to get through this thing. Up, they pulled. See that? They threw this in the hopper. They pulled it. Now, that means possibly we're going to sail through here, and this is the mean. So Remember how this works. If you sold here, you got to get risk neutral. If you sold here, your teeth would chatter. Our fear would take us out because we'd bail out, or we'd put our stop one tick over the swing. This is an easy way to give your dollars away. I'm not saying it doesn't. I'm just saying if that's your Pablo, if that's your trade plan, you trade it. This, I'm saying again, is up to the individual trader whether they want to trade it. We're trading reversion. Again, I don't call trades. The optimal location is out here. It could be anywhere. The thing with reversion is you don't know where the outside edge is. That's what makes it hard. This would be the target. And again, this isn't a trade I might not take. You're going here. Then the other possibility, and of course it could do anything. If it gets through here, we have this outside edge here. So this trade, if it clears this, and it might not, then the next area is out here. If it got under here, the next area would be there. And I'm not saying it will. I have no idea. This is reversion trading. It is a specific plan inside a plan, and it has to come to your vetted locations. Here's the thing with reversion. It could have come here and reverted. It could go there and revert. This is what makes reversion. These are all low volume areas. That's why we call mean reversion mean. Where's the outside edge? Now the next one is over here. There it is, LVN. Then you got another one up here. So all of these are possible. So when you're trading reversion, and I'll tell you, it's easy to take stops in reversion because they all look the same. This short looks the same as other ones where you're going to take stops. Who wants to take a stop? Raise your hand. You don't. Now this one, if you can't enter here, now here's the sweep. Here's the microstructure. Notice you have sweeps here, sweeps here. This right here, sweep. Buyers are here, sellers are here, break high. Nothing to do. Buyers are here, sellers are here, break high. Sweep. Nothing to do. Break low. This could be a short. This is microstructure. I'm just showing you ideas here. And if it was, now how about this? You have a short here. You draw your little box. You come up and sell it. Same thing that I'm showing you up above. And you sell it and your stop is here. Let's just look at a similar configuration. Boom, stopped out. See? This one works. Trading. You see what I'm saying? Randomness. Take a stop. Now you have to, instead of thinking about the stop, you have to understand mean reversion, which is mean. Where's the outside edge? Here. This could be a short or not. You see, it doesn't matter. Your trades are what matter, not mine. And this is where you'd be going. Now, it's either going to come all the way back because the market is found too low, or, see, the or is we're going to get below here, and then we're going to look for too low. And that could be anywhere out at these low volume outside edges. That's part of the thrill. Which one is the right one? For this to go lower, it's got to get under here. Okay? And what mean reversion is basically outside, back to the mean. This is the reversion. Back to, in fact, let me show you another little concept here that you might find interesting. In this microstructure, this is the mean. See that little node sticking out? That's the mean. So this is too high, too low, retail. Think of your mini mart. Break away, too high. Seller. So break here, it's a short. If you can't get short here, you wait because the probability is very good that it's going to return to where the buyers were and they failed. See, what happened here is buyers are here, sellers are here, no clue. Sellers take control and they're now below the buyers there and they're below the buyers here. So this can be a short here on a test, here, and this is really where your teeth chatter. So let's watch the behavior. The short is there. One tick below there. Stop would be above here. Right? Because that's your protection. Retail buy stops are going to go there. So you don't want to put your stop there. Me, I don't put my stop there. How many of you guys have said they picked me off? It's like they stole your order. No, they didn't. These stops coming out are retail traders who are risk adverse. We're all risk adverse. But do you consider this? If the sellers were here and buy stops get taken here, do you think the sellers here and here are waiting for another opportunity to sell it? So don't put your stop with these guys. Your stop needs to go out here. And now here, teeth chatter, sweep, break, another short. If that's your trade. Again, who knows? They pull, you see? So there's your target. Now, subject to the number of contracts, you can, if you took this, be done with the trade. There's nothing wrong with this. What do you think about this? So you have the possibility of the following. If you're running a 2-lot, you get risk neutral. Your stop stays there. You're out. Trade is done back in the Barca Lounger. Or you're running a 3-lot and you have one runner on and you have it at scratch. So if it comes all the way back here, you just scratch the runner out. If it can't get back here, and this is some pretty good buying. If it can't get back here, and it gets back under here, then you're going for a deeper target. And the thing is, we don't know that. So our job as traders is we don't know anything. The best you have is maybe. So maybe we'll come back here, test it, and we'll find our sellers again, these guys. Or now the buyers saw this as a deal, and there's your buying. That was pretty aggressive. You see it? Here's your sweep. Let's look at the opposite behavior. Buy sweep here, see you later. Sell sweep here, resistance. Really, there's your sellers, they're your sellers, and we're above these guys. So that suggests possibility to come back here and maybe the short's over. No clue. You guys have questions? So Pablo, the 87 might qualify if you vetted it. I mean, the thing, Pablo, about an LVN is they're just low volume areas. They're not walls. An LVN is a poorly auctioned area because the market ran through it. So when you have a low volume node or an outside edge, the market tends to return to it, like this one out here, because the market ran through it. That's one of the things, So now we want to just watch and see in here, what happens at these high volume areas. So there's really nothing more to do with this. This trade would just be short if you're position oriented. If you are trading these shorter rotations, subject to, again, your skill set, we want to watch this right here. So we want to watch this area coming up. Outside edges are hard for reversion. So reversion trading is like a specific plan inside a plan. As a day trader, we can trade this stuff. I, you know, but I also take more stops in reversion because what's hard about reversion. So the way I look at reversion trading is it's a probe at a location. And I'm trying to find a location to trade a behavior that is auction based. The randomness of these rotations, trying to say, is this the short here that you should take? Well, you'd be risk neutral. Is this the one? There's no trigger here. There's a trigger here. There's the liquidity. Is this the one? Is this the one? Yeah, that's the one. What about this one? Well, you wouldn't be stopped out. So this wouldn't work. So this short is workable. This one, you'd be risk neutral. You'd get scratch, and then you take it again. You take it again. If that's your trade, not saying it should be. And now we have our resistance here, and we have our buy stops here, and we have some pretty healthy buying in a sweep. So the question becomes, if you're on a 2 lot, you'd be done here. If you're on a 3, you'd be guarding. You'd be maybe, depending on your trade management scheme, you'd be scratching out the runner. Or when you see this and you have a buy trigger, that might be your trade management right here, and you'd be out of it. As soon as it's, here, let's look at this. So this is your target. Don't forget, it's a reversion trade. Right here, you have your sellers and you have a sweep. We have sweeps. Remember, we had a buy sweep up on the top. So this is a sell sweep. And what happens here is, this is where the sellers were and the sellers were. So here, the sellers, the buyers are here. I break high. So now this here is my support. I need to get below this and this to go lower. There's my test. Remember where the sellers were. Just see if you don't see something interesting here. This is how and it's just what I do to try to organize structure so I can be process oriented. So what do I know? I know I got my buyers here. I know my sellers were there. That's why the market went down. And I know my sellers were there. And why did the market go up? See the iceberg? Absorption. Who knows? Break high. Sellers now are underneath the buyers. Break high. There's my test. Sellers are here. They are absorbed. This tells me there's trouble in River City. So right here is support, and I have my sellers up here. Here's my resistance. So if I'm managing the trade, I could be out of the trade here, or subject to my ability, I could be looking at getting out of this thing. This is a good place to exit. Buyers are here. Sellers are there. Sellers are there. Sellers are there. Break high. What is this? Break high. Break high. This is where the buyers took control. I'm in micro. Let's look. Pull back. Absorption. Buyers are buying here. Buyers in control. Sellers in control here. Here's the micro structure. Micro high volume is there. This is a mean reversion in the microstructure. In a higher time frame, we're coming back to high volume, mean reversion. In here, micro high volume is here. Break high. That's a trigger. What is this? Micro high volume. That's a trigger. Sellers are here. Buyers are here. Break low. Trigger. Come back. Test. Too high. Return. What's too low? Here. Trigger. So what you have is a trigger and a trigger. Sell trigger, buy trigger. Higher time frame, this, objective. Target. So you have microstructure, target, microstructure, resistance, and you can use these after you define them. What happened here? Too low. Where was too high? It was there. What do I need to happen right there? Get below there and fall out. What does it do? Opposite. What does that tell you? Buyers are absorbing. See the change in behavior? So that's how you can use these I call them microstructures because I'm taking the same concept and I'm extrapolating it into multiple time frames. Where are we here? Notice where we came. Why did we come here and maybe react right exactly at the location where our shorts were? Because that's where the sellers are. Now, is that a short? Not for me. Is it a short for you? Could be. Me, not so much. Why? See the bind? Again, I don't call trades. Subject to, again, your plan and your skill set, you could sell this. And the idea would be to get risk neutral. Where's my last location where the buyers were? It was here. Buyers are still in charge. You see this? Now, the only thing I've got here is the sellers were here. So they might sell again, and there's the icebergs. But I have buyers. And where's the support? Sellers were here. Buyers. So I have no shorts, you see. But I know the shorts are there. If I was trading the long side, guess where I'd be targeting? There. Because that's where the sellers were. What I'm showing you are ways to kind of break it down. You see? And again, guys, this is all time frame specific in the rotations that you trade. CVP, just right click and create a profile. Create a profile and chart range accumulate instead of session. This is just session. This is chart. And it only shows the volume that's on the chart. So support is there. You see? Resistance is here. Support is here. Any doubt in your mind was support now is there. If you're a scalper, I'm not, then you'd be going to there. And this is not anything anybody ought to do until you can trade a broad stroke. You know, something like this to this. Then manage the trade either there. When it doesn't get below, then you know the trade has a problem and you know for sure here that you should be out. Guys, when it comes to trade plans, you have to vet your own plan. Do not follow anybody else's. That's no different than going out on YouTube world and finding the secret sauce. It won't work for you. Because part of, a good part of this trading business is psychological alignment. Like myself, I trade larger rotations. For me, it's a risk reward thing. I'm pretty comfortable when I take stops. If I'm risking the same amount for a 20 or 30 point trade and I take a stop, it doesn't affect me the same way it would if I'm risking, let's say, 3 points with multiple contracts and I'm going for 4 points, or something, or 5. That doesn't pay risk reward. So it changes it for me because I take less trades. Now, a lot of us think this is a video game. How many trades can I take? This is not the business, guys. It's every time you put a trade on, you're taking risk, right? So if you're taking more trades, you're taking more risk. So you have to have a probability or a statistic that actually pays you for taking that risk. You're going to find, of course, we all take stops. So I take stops. My experience emotionally is more as long as I'm doing everything I should do. See the behavior? As long as I'm doing everything I should do, it's more of a probe of location because I can have the right idea and everything else and still take stops. It just means the market and the location I have just didn't align, so I'll take the same trade at a different location. So remember what this is. If you got long, your target is here. If you're protecting a runner, it would be behind here, or your trade manager tells you to get out here. What's the right answer? The answer lies in your plan. You cannot make these decisions Joe, make sure that if your POCs that you're using volume point of control, not point of control. Point of control is time-based. Volume point of control is something else. Make sure you got the right thing. If you're using TPOs, it depends what chart you're using too. TPO chart might show you something different, and it's also based on the tick size. My TPO doesn't always agree with my regular other charts. Make sure you're looking at the right thing. So this is a sell sweep. Sell sweep suggests higher. Notice you have a sell sweep suggests higher. At the top end of the rotation, buy sweeps, like here, can suggest lower. When I get a sell sweep up here, I want to see a buy sweep. For lower, I get a sell sweep, suggests continuation, and doesn't have to do anything. So there's no short for me here. If it's a long, it's a target. Me, I don't take the long. I'm just telling you, it's just me. Those aren't recommendations. You see, the thing about TraderLab, it's not about what I do. I have adjusted how I trade to the rotational structure, and that works for me. And the other part that works for me is I like to try, when I get profits, and of course I like to get those early on, I trade the open, which is a very high risk place, last place anybody ought to trade. I trade there, and I also take more stops there because there's no structure. So you have to already know what you're going to do on the open, subject to, but you have very little information, and it's very fast because a lot of banks and hedge funds and the rest of the guys have to do their business on the open. They just marking on open orders, and so volume and volatility is high, as you guys know if you watch volume, as the last hour has high volume too. So if I trade the open and I get the rotation, and they're often larger on the open, and I have profits, I will leverage the profits. And again, not a recommendation, but then I may take more trades that are not A plus. They're a little lower on the food chain, but I'm using profits, or I use profits to increase size. But I'm saying it's trade plan specific. There are going to be times when from experience that one side is trapped. And part of that had to do with Friday, because the market is short. Always remember, the market goes up to go down, and the market goes down to go up. The market went down on Friday, so we can go up to squeeze. That was my plan for today, to squeeze, and we actually did squeeze Friday's high. We didn't get Thursday's high. And then, but it turned out that we only got Friday's high, and that was the place to be getting short. So I got out of alignment for myself, and that was my fault and my error, not to take the first short that I saw. Said I was looking for it to come across, then take the short. So I was, all right. So then I took continuation trades instead of the opening trade. But for developing traders, you shouldn't be trading there anyway. So it's still a very profitable day, So it's just the way it comes. Yeah, Joe, I can't answer the question for you. Yeah, drop a ticket over to support there. Sorry. So there's nothing to do here, guys. The only way, and this is not for developing traders, this kind of trading, this is really advanced stuff, because what you're doing is you're plucking structure, and you don't have a lot here. I mean, this is doable, and it's not at a location that developing traders ought to trade. You should just be in your Barca lounger, because FOMO is going to get you operating in stuff where there's really very little, to hang on to. You don't want to do that. Introductions is asking me, would the open range trade still be something to look into for a sense of direction? Yeah, you could look at it, but you shouldn't trade it, and that will stimulate FOMO. Or VPOC migrations. You can get a lot of information from the open when you see the range of the rotations and get a sense of who's dominant. when you get like this morning, one directional, basically one push, and you're not seeing the counter rotations, really minor counter rotations, that just shows you a higher time frame is pretty aggressive, and you want to find your continuation trades for it. And actually, the shorts set up pretty well this morning. They really fit the 6908. So Friday's high in 6908 were locations that were really, you could have these, and then you just want to wait. Oh, sorry, just might have lost the chats. So this is where the high volume. Here, let me come back. Try to do this. This was the highest volume price for this consolidation, these multiple days. So this is Thursday. So this was resistance on Thursday. This is the retail price from, brain is going here. I'm sorry. Yeah, this is today. This is Friday. This is Thursday. So this is the high volume price. This is resistance. When you add this day in, and this is current, okay, this moves down. So today we have Friday's high, and we have this former high volume retail price 6908. So 6908 is resistance coming in for today, and so is this. So when you open above this, you're squeezing these shorts out, and now this is resistance. And then we did the Acapulco cliff dive, and now we can do anything now. You know, we can have an outside day, or we can come back across and squeeze these guys out. That part we don't know. So now this is the retail price from this consolidation. This is the developing value area where most of the volume is currently. So now we can just rotate in here. So this can set up reversion trading. And this is the current retail price, 68.75. So we can come back here. That kind of sets up our, this is kind of your sandbox. But you'll notice now we've come back to resistance, which was this. And this liquidity is back in. So now you want to watch the behavior, because what this says to me, that the sellers that were here are defending this location, but we got these sweeps here. So there's conflict here. For me, I don't have a trade here. And the reason is because of this. And it can still come back here and fall out the bottom. But this is, see the buying here? So the selling was aggressive here, but my buying is aggressive here. So and what else? Shorts have buy stops here. So this is a vulnerable position. So if you're an aggressive trader, you'd be looking at this. Me, I'm just in the Barca lounger. And yesterday's high is here. And you'll notice where the high is. See where the open was? Right against 08. So if you are using the auction and volume profile, the concept of what the market actually is, you would know right here at the open, we took the stops out and we tested this key level at 08, which I just showed you. That sets up the shorts. So it would have been short, and you have a number of short opportunities, and wherever you go, you go. Now, if things got really juicy, we take out yesterday's low, and that would be an outside day. But it doesn't look like that is happening at the moment. And of course, I have no way of knowing. Hope you're getting something out of this, guys. This is just trading. It is what it is, and you have to have a plan for it. It's not about catching every wiggle. It's really about only taking the trades that fit. So there's nothing to do here, guys. It's just sit back and wait. It's not a video game. If you want to stay in the business, you're going to be very selective. And you're also going to think about how retail traders behave. I always say, and write this down, think like a retail trader. Don't act like one. They don't stay in the business. Why? Because they're doing the things that sustainable traders, career traders don't do. That's why. Does that make sense? And so do you see the location? So this is resistance. Buy stops are here. Buyers are active. I'm getting the sell sweeps. This suggests to me we're going to go higher. I have nothing to do except be a tourist. This is the last trade, and even that was not at the location in its reversion. That's the mean. My buyers are here. What does it say? Potentially too low. What's the condition of the market? Short. What can we anticipate? Not predict. Squeeze. To where? Good luck with that. Where might it go? Out here. What might happen? And these aren't recommendations. Reversion. Or, back to the or more squeeze. And again, nobody knows. Hope you're getting something out of this, guys. Please leave a like. If you're in YouTube, review the stream. Better yet, feel free to use the link in the bottom of YouTube. Visit the Bookmap Discord Trader Lab community. Trader Lab's a group of like-minded traders who come together to leverage their collective experience. This is about the business of trading. There's no holy grail. Wouldn't it be nice? There isn't. What there is trade plan and being in a community of serious traders. This is not romper room. It's the business of trading, building trade plans, developing statistical edge, dealing with the psychological obstacles of uncertainty and risk. It is the hardest part of this. Anyone, I believe, who comes to Trader Lab and does the work can learn how to trade. Being able to trade in spite of whatever you have is really a psychological issue. And the only way you get control over psychology, which is primal, avoid fear, create certainty, which doesn't exist here, is statistical probabilities. If you don't have anything statistical and you only have the chemicals circulating in your brain, which is fight and flight and the rest of it, then you're being driven and control. Your business is being controlled by how you feel, your emotions. The professional trader, the career trader, knows what they will do when it shows up. You're not making it up here. You're responding to the things you've vetted. If you have vetted taking a trade at whatever location it is, your job is when it shows up, because you understand you have an edge, but a 50-50 outcome for that individual iteration. You put the trade on, you take your stop, or it does its thing. When you have a vetted trade management process and you're thinking the trade, your target is here, and you get a reversal structure that's vetted that says exit, that's your job. Or you have a trade management process that says your runner on your 3 lot gets scratched and that's it. You're back in your Barca lounger. No decisions are made here. It's all done before you put the first trade on. That's how the business works. If you're interested in learning the business of trading, I invite you to Trader Lab. Use the link in the bottom of YouTube, and there's a lot of additional education. It's all available at no cost. Don't forget to give a like. We need the thumb. It keeps the stream going. There's no cost for Trader Lab. Use the link down there if you want to visit. It is a serious community of career-based developing traders. If that's your objective, then visit Trader Lab. Take care, guys. Look forward to seeing you tomorrow. And thanks so much for visiting the Trader Lab today.